Hello and welcome to Econoday Unplugged on Tuesday, the 10th of January 2020. And since this is our first podcast of the year, and indeed the new decade, on behalf of the entire Econoday team, here's to a happy and hopefully profitable one. Mark Pender is across the pond stateside, Brian Jackson joins us from Sydney, and I'm Jeremy Hawkins here in London with a touch of flu, so apologies if the voice gives out halfway through. So, is it out with the old and in with the new, or will 2020 simply be a case of more of the same? Talk of recession in 2019 proved overly pessimistic, but many central banks were still forced to cut interest rates and or dig deeper into their non-standard monetary toolkits. And that despite increasing concerns about distortions that very low, if not negative interest rates were already causing to financial markets. 2020 has kicked off with a serious escalation in Middle East tensions, and there's sure to be many shocks more for investors to contemplate before the new year's out. So what's likely to be the key events and themes over coming months and quarters? Mark, you're up first. The US in 2020. What do you think will matter most to financial markets, and where might the surprises be?
Well, I think what always matters most is the labor market. And as long as job growth remains solid, it slowed a little bit last year, but it was still better than, it was still very, very good. And if wages start to show any kind of traction at all, that would be interesting. I don't know if it would trigger any kind of rate move. I think the Federal Reserve is probably stepped aside because we also have an election over here in 2020. So and that's going to kick off pretty soon. So there will be a lot, and the Fed will want to, take cover, I'm sure.
Can I quickly intervene on that? How important do you think the US election is to financial markets this year? I mean, I know it's a big political event. Do you think it's a big investor focus as well?
No, I think it's much more political. I think it's much more superficial. I think that the economy and the government bureaucracy, the nation as a whole, has an underlying momentum, and it would take a very serious breakaway from traditional policy to even begin to shake up the thrust of the U.S. growth, U.S. economy. Certainly, there was a lot of that, with on the fringes at least, with the trade issues, and this threatened or risked changing that, perhaps improving that. But I think it's much more of a political showboat kind of a thing than it would be. For the markets, I think that's going to be really clear with the Fed stepping aside. And do
you think Trump and co will be putting fresh pressure on the Fed to try and come out and cut interest rates again?
That's an interesting question. They already had, you could look at it that way.
Plenty of it, yeah.
You got three of them, right, in a row. So that might be enough for right now. Certainly, if the economy does go down, that could definitely trigger heat on the Federal Reserve. But if the general trend of what we're seeing, the risk right now in the U.S. still is the factory sector. We had factory orders today, and they were soft, and core capital goods are sagging, which is a sign of a lower business investment. But there was very strong business investment in the prior years, and levels are very high, whether it's consumer spending or actual the levels of business investment are still very high. So what would it take? It would, is there a risk? Is it possible that inflation will emerge, or is the labor market, is labor so constrained right now, as far as, at least in the U.S., as far as unions, as far as getting any kind of cohesive power together. And now we're coming up against the possibility now of a limited supply of labor, given the strength of the labor market. We've seen that before. It hasn't happened. I think if that happens, I'm not even sure it would be a negative, but for the outlook, it could be a very strong positive for the financial markets, having consumers make more money. But that, I think, if I had a pet, something that I was looking for 2020, that's what I keep my eyes on, to see if wages actually do start to show any traction here, or how about in Europe, Jeremy, or in Asia, Brian?
Yeah, I mean, definitely that's something that policymakers right across the region are looking for. Particularly if you look at places like Australia and Japan, they've been talking about the need to have wage growth pick up if they're going to be able to change direction on monetary policy. And as we come into 2020, there's still not a lot of sign of that happening. So, I think generally speaking, the outlook is still for monetary policy being kept fairly accommodative across this part of the world.
On that note, then, Brian, since in your part, of the world, I noticed that the People's Bank of China, they've already cut their bank's reserve requirements ratio this year. I mean, should that be seen as good news in a sense they're looking to promote growth, or should it be worrying to investors because it perhaps means that the economy could be a major worry in 2020?
Well, the PBOC uses that tool for a variety of reasons, not necessarily always as a way of managing economic activity, but sometimes just purely to try and manage liquidity conditions according to what's going on. I think what that might have been driving that was just the fact that we've got Chinese Lunar New Year holidays coming up relatively early this time of the year. The last couple of years we've had those holidays fall in February. This year it's falling late January. So every time that happens, you do see a bit of a move by officials to just make sure the liquidity conditions are okay. But that said, it obviously also might be driven in part by thinking that they need to do a little bit more to provide a bit of a boost to the economy. But that's sort of really at the margins.
Okay, so what's the because I'm given how important China is in this stuff now. What's the outlook for China in 2020? Are investors getting to the stage they're thinking it's bottoming out and things are picking up, or is it still more of a slowdown?
Well, the trouble is we're really coming into that time of the year where we don't have a lot of visibility about what's going on in China. Definitely, if we look at the numbers coming into the end of 2019, things were pretty subdued across most parts of the economy. If you look at PMI numbers or exports or some of the activity numbers, but we're getting the December numbers last week and then coming up in the next couple of weeks. But after that, we do have this period where because of the Lunar New Year holidays, we don't get data for January until we get to March. What the Chinese authorities do is they consolidate the January and February numbers together to try and remove the distortion caused by the timing of Lunar New Year holidays. And so we're not going to get any sort of visibility on what's going on at the start of the year until we get to March. And it also has an impact on numbers right across the region. Even those countries that do report January numbers in February, it's going to be impacted to a certain extent by what's happening with the Lunar New Year holidays. So
Brian,
that said,
when exactly is the lunar holidays this year?
So they're starting late January, and that's going to have an impact on the data because the last 2 years those numbers were in February. So that's going to have all sorts of impacts on year-on-year growth numbers that are calculated, not just for the Chinese numbers, but numbers right across the region.
There's a big calendar effects, but is this a 10-day thing, a 2-week thing?
Yeah, I mean they have quite an extended holiday period. So you have probably about 5 or 6 days of actual holidays, but there's also impacts as businesses and consumers get ready for the holidays, and then as they sort of come back to work after the holidays.
Okay, talking of visibility, I don't know if you can see through the Sydney fires at the moment, given what's going on in your part of the world, but do these fires have any significant implications for the Australian economy as a whole? And given there was some talk last year about the possibility of quantitative easing at some point if rates had to come down much further, do you think it perhaps that increases the chances of further easing out the RBA?
I think it probably does. I don't believe that you're going to see much of an impact at the aggregate level for the economy, though of course there is a lot of devastation and disruption in the affected areas. If anything, it may actually provide a boost to economic growth because we are going to see a lot of activity in terms of reconstruction and assistance, and also some additional spending probably on preparation and emergency response efforts. So if anything, I think the impact will probably be on fiscal policy. So the national government here has been very committed to tightening fiscal policy and returning the fiscal balance to a surplus. And it's actually come under criticism for this, both directly from political opponents, but also indirectly to some extent from officials at the Reserve Bank. So when you add this, to this criticism for fiscal tightness, the additional criticism that we've seen in recent weeks about the government's preparation and response to the bushfires, it's not too difficult to predict that there'll be some substantial extra spending delivered in response. And so that actually might help the RBA keep policy on hold if they're finding that the fiscal stimulus is coming instead of additional monetary policy stimulus. But either way, I think we will get a bit more support to the economy going forward.
Okay. And across the water, as Mark said, probably not too much an impact on the US stuff from the US election. But New Zealand, I think, have an election coming up later on this year. Is there much attention being paid to that?
Not at the moment, no. I think, just in terms of policy outlook, again, they're still fairly accommodative and not sort of, there's no sort of sign of any big shift in policy in New Zealand at the moment.
Okay. And I suppose we should also quickly mention Hong Kong. We left 2019 with the riots still in full force. Are they still running at the moment? And well, really, what do you think the implications of the ongoing disruptions might be for Hong Kong economy, and indeed any wider implications as well, for that matter?
Yeah, again, it does seem that 2020 is still going to be very challenging conditions for the Hong Kong economy. The latest number that we had was the PMI survey. It picked up a little bit, but still showed the Hong Kong economy in very sharp contraction. And again, it's going to be impacted by the Lunar New Year holidays over the next couple of months. So it might be a little bit difficult to get a good read on what's going on. But you would think that it's going to be a slow recovery there. We will have the Hong Kong government delivering their budget. It's going to be probably mid-February, late February. So you'll probably see a bit of a fiscal package there, I think, to try and placate some of the protesters, but also just try and provide a bit of support to businesses there.
Okay, excellent. All right, so what about Europe then? Well, I suppose just beginning with whether a shock's going to come, because I don't think there's really too much to get excited about in terms of the economy. I think the general expectation is that growth is probably close to the bottom now. Europe will avoid a recession. You may start to see some modest pickup coming through during the course of 2020. But I think in terms of looking for surprise, I kind of go along where Mark was coming from his side of the water. And that is, I guess, keep an eye on wages. For so long now, when we're doing these podcasts, we talk about inflation in the Eurozone just being hopelessly low, and it's missing the ECB target on a really on a year-on-year basis. Well, we have seen a fairly significant acceleration in wages, not to high levels. We're currently only running at about 2.75% or so on an annual basis, but nonetheless, we are starting to see these wages responding to what, by European standards, certainly not US standards or many other countries' standards, but by European standards, is a tight labour market. And so I suppose it could be the case if we see some surprises coming through on the real economy. I mean, I think most people are hoping that we'll see some sort of turnaround in, well, not just Eurozone manufacturing, but global manufacturing during the course of the year. If that were to spur a still tighter labour market and higher wages, we could perhaps start to see inflation moving up towards the ECB's current near 2% target rate sooner than currently discounted. And were that to happen, bear in mind we do at the moment have a very much split council, governing council under the new president, Christine Lagarde. Many who didn't want to see a cut in interest rates and the restart of quantitative easing towards the end of last year. It could possibly, at the outside at least, be the case that we start to see the central bank beginning to introduce some kind of tightening process, or at least ending quantitative easing by the end of 2020 and in advance of what markets are anticipating. That at this stage, I think, is still got to be very much an outside call, because the economy is still very sluggish and inflation, despite some recent pickup, remains well short of target. But again, as Mark was saying, I think it's an idea certainly to keep an eye on the Eurozone labour market as kind of a potential leading indicator of where the ECB may be going. The other stuff that is coming out from the ECB, of course, as we touched on before, is that it is going to go green this year. So the European Central Bank will be looking increasingly favourably at companies with a more environmentally friendly footprint during the course of the year. And it's not just going to be monetary policy in Europe either. The new EU Commission President, Ursula von der Leyen, has announced that she wants to launch a Green Deal to tackle climate change too, involving potentially a fair amount of money being thrown at different parts of Eurozone industry. So I think, one of the changes we will see during the course of 2020 versus 2019 is to some extent the shape of the ECB's own portfolio, with a growing emphasis, and it's still only tiny at the moment, but a growing emphasis on the more sustainably based companies. And indeed also perhaps we'll see more and more of a general attitude towards that as far as fiscal policy is concerned. The thing that I think is currently stand for investors within Europe, so-called sort of sustainable investing, is now a tiny part of most investors' portfolios. So there's plenty of potential there, I think, for that to be expanded over the course of coming months.
Jeremy, can we on that note pass it over to Brian and tell us what the Australian public is saying about sustainability, climate change right now?
Yeah, good point.
It's a big debate, but it probably has continued to fall between different political views, and so hasn't really, I don't think, been a lot of consensus about it. Obviously, for people who are very worried about climate change, they attribute these bushfires, the increasing. Well, again, that's up for debate, whether they are actually more severe or more frequent than previously. But for part of the community, the belief is that climate change is worsening the problem, whereas there are also other people who instead point to land management practices as being a factor in that. In the past, we have in Australia always tried to reduce the impact of bushfires by doing controlled burns during the winter. So some debate about whether that has not been done to the extent that it should be. So to be honest, it's been it's quite a polarised debate here in Australia, and it sort of really hasn't, I don't think, developed a broad-based consensus yet.
Okay, thanks. Okay, so Randy, off to a couple of other, I suppose, main issues as far as Europe's concerned. One, I think, is something else to look out for during the course of this year is this potentially a shift away from the focus on monetary policy towards fiscal policy to get growth going. I think it's pretty fair to say that a lot of central banks now, and it's certainly true of the ECB, are running out of ammunition. And interest rates, as we know, are already in negative territory. A number of individual national central bank governors are extremely unhappy about that. Quantitative easing, the mention, has been restarted. A number of central bank governors don't like that either. So there's more and more calls we've seen ever since Mario Draghi announced his resignation or departure, that there should be greater fiscal stimulus coming out of a variety of governments, and that also looks to be the case as far as Lagarde's concerned as well. So I think we should start to see fiscal policy being loosened more and more, and certainly a lot of EU countries have got room for it, notably Germany, during the course of 2020. So fiscal policy perhaps providing or filling in the hole that monetary policy might be forced to leave open as we go through 2020. The other aspect, of course, which we still can't ignore, even if most of us would like to, for Europe, is Brexit. Brexit officially, of course, will be happening. It looks almost a done deal now for the end of January, so just a matter of weeks away. But that's, if you like, is the easy bit. The crucial bit as far as financial markets is concerned is what form and shape Brexit is going to take. And that will be determined over the course of the following 11 months, during which the UK and the EU will be trying to sort out and thrash out a trade deal. Now, most people, I think, are taking the view that 11 months to sort out a trade deal is far too short and means that at best we'll end up with some kind of very general deal, which is likely to just to cover trading goods. So the key financial financial services sector for the UK could be simply be left out of it. Were that to be the case, the chances are investors would start to see it as being a hard Brexit, and that's not going to be good news for the pound, and it wouldn't be good news for financial markets. Now, it may be the case, given how we've had all these swings and roundabouts concerning Brexit for so long now, that there will be some sort of extension to this deal. But as it currently stands under UK law, that's been forbidden as a result of some of the bills which went through Parliament at the back end of last year. So Brexit is still very much going to be a focal point for investors, not just for sterling markets, but also for what's happening in European markets in general. What else should I be mentioning? I suppose, as far as just some of the slightly more peripheral countries, keep an eye on Switzerland. As we talk, the Swiss franc has started off at one of its strongest levels against the euro in the last several years. That safe haven flows due to the Middle East developments we have ongoing at the moment. As we talked about before, the Swiss National Bank won't be at all happy with this. So it raises a possibility of still lower interest rates or some form of additional policy loosening coming out of the SNB over coming weeks, if not months. We will be getting a new Bank of England governor, I should mention, but I wouldn't place too much attention to that on the grounds that it's highly unlikely that he'll be doing anything in terms of changing policy. He'll be Andrew Bailey, used to be a former deputy governor with the Bank of England, and indeed he has 30 years experience at the Bank of England. Widely seen as a safe pair of hands, probably a dove, but really should leave policy vis-a-vis Mark Carney, the outgoing governor, pretty well unchanged. Also should mention, in terms of changes in central bank governors, Stephen Poloz, the Bank of Canada governor, his term ends in June as well. His departure will bring in someone new, obviously. And I guess if we look around the world at the moment, Canada at least has some scope for lower interest rates compared to most of the others. In terms of bonds, chaps, what do people think about bond markets? Do we think that yields can go any lower, or have they bottomed now?
Well, they can go lower in the U.S. I mean, it's much higher in the U.S. than anywhere else, and of the major economies. And the U.S. bond rates were held down all year, even though they're higher than others, despite a 30% rise in government spending, and plus the year before that, something similar. So greater Treasury issuance, which is back to our fiscal policy discussion, and fiscal stimulus going into an election year. It doesn't seem to have affected the demand for U.S. Treasuries. But what do you guys make of the U.S. Treasury market?
Well, from my side, I think it potentially still has further to rally. I think if the rest of the world continues to chug along with low inflation, low rates of economic activity, then, as you say, you still have, compared to a lot of other countries, relatively attractive yields. And I think that's going to bull in buyers. And if that's the case, then there's scope for it to come down lower. But if we were to see, I guess one of the big issues we haven't actually talked about yet is what's going to happen with the US-China trade relationship. Well, Mark and Brian, if you've got any feelings as to which way this is going to go, and we know it seems like this phase one deal will be settled sooner rather than later, but is there much going to happen beyond that? Because I think, as we saw last year, global trade had a huge impact on asset prices in general. So what comes out of these trade talks over the course of coming months, presumably is going to have just a bigger impact on 2020 as well. So is there a sense which way they might go?
Well, I mean, my hunch over here is with the for what do they call it, the initial signing, which is scheduled, I think, in a couple of weeks. That seems to have cooled down the tensions. But where have we come along? I mean, the U.S. we just had trade data today, and year-on-year change for imports and exports, even though exports improved noticeably in the November data, that they were flat or they're in contraction. And that is a repeated theme across the major economies. So global trade has leveled out, and it seems to be tied directly to U.S. actions. Will they accelerate this next year? My hunch is probably not. It seems like that energy has been dissipated. I could be wrong, but what do you think, Brian?
Well, I mean, hopefully the phase one deal will at least stabilize things and hopefully provide some support. But the key risk, I think, going forward is just going to be whether trade becomes a big issue during the US elections, and whether that really puts a hold on any meaningful progress.
Okay. Anyone else got anything they feel burning issues we should be adding? Otherwise, I'll try and pull this together. So I think on the whole, then, what do we got? Well, I guess expectations seem, cautiously positive for 2020, but the likelihood of at least a global recession has diminished somewhat from certainly compared to where we were this time last year. US, kind of chugging along with the Fed largely on hold. But for a number of countries, current rates of global growth may need a looser fiscal policy as the central banks are running out of room to ease that much further. Global trade is going to be a big issue, as just mentioned, as far as 2020 is concerned, and I guess the risk is there that we do see some kind of breakdown, and that really would pose serious downside potential for, well, not just equity markets but economic growth, as I think a lot of current the hopes for the global economy in 2020 really are based on a rebound in manufacturing. As long as we get China sort of doing okay, the trade deals go through, then with Mark talking US interest rates remaining nice and low, then unless we're going to get a strong dollar, that ought to be a relatively attractive environment, I guess, for the emerging markets. So there should be some reasonable value in riskier assets as well. The risk there, I suppose, particularly is that if we do see, let's say, the Fed keeping interest rates where they are and interest rates elsewhere still going lower, we see a stronger dollar, which would really put a proverbial spanner in the works. Europe, really, irrespective of what the ECB does, the still major focus this year is going to be what on the earth happens to the Brexit talks. So do keep an eye on them. You probably can't take your eye off them anyway, but they were very much determining the profile of asset prices pretty well across the board. And as we mentioned, don't forget, Europe is going green, even if other countries aren't. Okay, anyone for anything else? In which case, okay, let's end it there then. I think there's probably more than enough to chew over, and that's not even including all those events that no one's forecast yet. So from Mark, Brian and myself, thanks as always for listening. Don't forget to keep up to date with our 24-hour-a-day Econoday global economic calendar, and we'll be back next week. Bye for now.